In February 2022, when Russian tanks crossed the Ukrainian border, the world witnessed not merely a military invasion, but the beginning of a silent and irreversible transformation in the global financial architecture. The Western response was swift, coordinated, and, at first glance, devastating, cutting Russia from the SWIFT system. This measure, presented as the ultimate economic weapon, was celebrated as a death blow against Moscow. Western politicians proclaimed victory before the battle had even ended. But while media spotlights concentrated on the immediate effects upon Russia, few realized that this decision had unleashed something far larger and far more dangerous for the West itself: the beginning of the end of American dollar hegemony. SWIFT, or the Society for Worldwide Interbank Financial Telecommunication, is not merely a banking messaging system. It is the invisible backbone of global commerce, the universal language that allows banks in Tokyo to communicate with banks in Sao Paulo, that enables Chinese exporters to receive payments from European importers, that facilitates the buying and selling of oil in distant markets. Created in 1973, SWIFT was processing, by 2022, more than 42 million financial messages per day, connecting over 11,000 institutions across 200 countries. And at the center of this system, like a sun around which everything orbits, stood the American dollar. Approximately 40% of all international transactions were denominated in dollars, not because it was technically necessary, but because it was convenient, safe, and, above all, inevitable. This convenience had a hidden price: control. Over the decades, the United States transformed SWIFT and the dollar itself into instruments of foreign policy. Iran, North Korea, Venezuela all experienced the power of being cut from the global financial system. But these were smaller countries, peripheral economies, that could be isolated without causing major tremors in the system. Russia was different. As the world's 11th largest economy, the largest natural gas exporter, second largest oil exporter, and critical supplier of wheat, fertilizers, and rare metals, Russia was not a peripheral actor. It was a central piece of the global supply chain. When, on February 26, 2022, the European Union, United States, United Kingdom, and Canada announced that selected Russian banks would be excluded from SWIFT, the measure was described as a financial nuclear bomb. The ruble collapsed 30% within days. The Russian stock market remained closed for nearly a month. Western companies rushed to terminate operations on Russian territory. It seemed, superficially, that the West had won without firing a shot. But this impression was a dangerous illusion, built upon the false premise that the world would continue accepting indefinitely a financial system where a single nation could unilaterally turn off the tap of global commerce. What Western strategists underestimated was the reaction this measure would provoke not only in Moscow, but in Beijing, New Delhi, Riyadh, Brasilia, and dozens of other capitals around the world. Countries that watched attentively, calculating risks, asking uncomfortable questions. If the United States can do this to Russia today, what prevents them from doing it to us tomorrow? This question, whispered in central bank boardrooms and finance ministries, unleashed a tectonic movement. It was not dramatic, it did not appear in headlines, but it was relentless. China, which had already been developing its own international payment system, CIPS, the cross-border interbank payment system, dramatically accelerated its implementation. What had been a long-term project became an urgent strategic priority. India, which maintained historical ties with Russia and depended on its oil and armaments, began negotiating in rupees and rubles, completely bypassing the dollar. Saudi Arabia, traditional ally of the United States and pillar of the petrodollar system, initiated discreet conversations with Beijing about accepting yuan for barrels of oil, something unthinkable just years earlier. And Russia itself? Far from collapsing, Moscow began constructing an economic fortress. The country demanded that unfriendly nations pay for natural gas in rubles, effectively forcing Europe to buy Russian currency to keep lights on and homes heated. Bilateral agreements flourished. Trade with China skyrocketed, surpassing $190 billion already in 2022, with a large portion denominated in yuan and rubles. Transactions with India, Turkey, Iran, and other countries bypassed SWIFT through alternative systems, correspondent banking channels, and even sophisticated barter agreements. What began to emerge was not Russia's isolation, but the fragmentation of the global financial system. Two parallel realities began to coexist: the traditional world, still dominated by the dollar and SWIFT, and a new world in formation, where nations actively sought alternatives, diversified reserves, built regional payment systems, and openly questioned the need to maintain the dollar as the universal reserve currency. And the more this second world grew, the more the weapon that should have destroyed Russia revealed itself as a bullet in the West's own foot. The decision to cut Russia from SWIFT did not destroy Moscow, but it may have initiated something far more significant: the slow, inevitable, and irreversible destruction of the financial order that sustained American supremacy for more than 70 years. The dominance of the American dollar was never an accident of history. It was engineered, constructed brick by brick through a series of deliberate decisions that transformed a national currency into the world's financial infrastructure. To understand why cutting Russia from SWIFT threatened this supremacy, we must first understand how that supremacy was built, and why it had already begun showing cracks long before the first Russian tank rolled into Ukraine. The story begins in July 1944 in the mountain resort town of Bretton Woods, New Hampshire. World War II was still raging, but Allied victory seemed inevitable. Representatives from 44 nations gathered to design the post-war economic order. The system they created was elegantly simple. The dollar would be pegged to gold at $35 per ounce, and all other currencies would be pegged to the dollar. America emerged from the war with 2/3 of the world's gold reserves and an industrial base untouched by bombing. The dollar became, quite literally, as good as gold. For nearly 3 decades, this arrangement functioned smoothly, undergirding an unprecedented era of global economic expansion. But by the late 1960s, the system was straining. The Vietnam War and Lyndon Johnson's Great Society programs were expensive. America was printing more dollars than it had gold to back them. Foreign governments, particularly France under Charles de Gaulle, began demanding gold in exchange for their dollar reserves. The vault at Fort Knox was being drained. On August 15, 1971, President Richard Nixon did the unthinkable. He severed the dollar's link to gold entirely. The Bretton Woods system died that day. Many predicted chaos, the collapse of American financial hegemony, hyperinflation. They were wrong. What saved the dollar was not gold, but oil. In 1974, in a masterful piece of geopolitical engineering, the United States struck a deal with Saudi Arabia. The kingdom would sell its oil exclusively in dollars and invest its surplus revenues in U.S. Treasury bonds. In exchange, America would provide military protection and support for the Saudi regime. Within years, OPEC followed suit. Suddenly, every nation on Earth needed dollars, not to trade with America necessarily, but to buy the energy that powered their economies. The petrodollar was born. This arrangement was more powerful than the gold standard ever was. Gold reserves were finite and static, but oil demand grew every year, and with it, global demand for dollars. This system granted the United States extraordinary privileges. It could run massive trade deficits indefinitely because the world needed to accumulate dollars. It could borrow at exceptionally low interest rates because foreign central banks parked their reserves in U.S. Treasury bonds. Most importantly, it could impose its foreign policy through financial sanctions, confident that no alternative existed. SWIFT, launched in 1973, became the enforcement mechanism. Controlling access to SWIFT meant controlling access to dollars, and controlling access to dollars meant controlling access to the global economy. But empires overreach, and monetary empires are no exception. The first warning came in the aftermath of the 2008 financial crisis. The Federal Reserve, desperate to prevent economic collapse, launched quantitative easing, essentially printing trillions of dollars. This saved American banks, but flooded the world with cheap dollars, inflating asset bubbles from Shanghai to Sao Paulo. Emerging economies watched their currencies whipsaw as hot money flowed in and out. The message was clear. America would manage the dollar for American interests, and the rest of the world would simply have to adapt to the consequences. The second warning came with the escalating use of financial sanctions as a primary tool of American foreign policy. After Russia's 2014 annexation of Crimea, the U.S. Treasury Department's Office of Foreign Assets Control became increasingly aggressive. Sanctions weren't just applied to governments anymore, but to individuals, companies, and entire sectors. European banks were fined billions for violating American sanctions on Iran, sanctions that Europe itself did not support. The message was equally clear. Even America's allies were not immune to Washington's financial reach. The dollar was no longer just a currency, it was a weapon. China watched all of this with particular attention. Since joining the World Trade Organization in 2001, China had accumulated over $3 trillion in foreign exchange reserves, the vast majority held in dollar-denominated assets. This made Beijing the world's largest creditor to the United States, but it also made China profoundly vulnerable. What if political tensions escalated? What if America froze Chinese assets the way it had frozen Iranian and Venezuelan assets? The Communist Party understood that true sovereignty required monetary independence. Beijing's response was patient and methodical. In 2015, China launched CIPS, its alternative to SWIFT. Initially, it handled only a tiny fraction of global transactions, but infrastructure was being laid. China began signing currency swap agreements with dozens of countries, allowing bilateral trade in yuan rather than dollars. It established the Asian Infrastructure Investment Bank as an alternative to Western-dominated institutions like the World Bank. It launched the Belt and Road Initiative, financing infrastructure projects across Asia, Africa, and Europe, projects that would naturally use yuan financing and create yuan-denominated debt. Each step was small. Individually, none threatened dollar dominance, but collectively, they were building a parallel financial ecosystem. The third warning came with the rise of cryptocurrencies and blockchain technology. Bitcoin, launched in 2009, was initially dismissed as a curiosity, a toy for libertarians and criminals. But the underlying technology demonstrated that cross-border value transfer did not require banks, did not require SWIFT, and did not require dollars. By 2021, El Salvador had adopted Bitcoin as legal tender. Stablecoins, cryptocurrencies pegged to traditional currencies, were processing hundreds of billions in transactions. Central banks worldwide, including China's, were developing digital currencies. The technological foundation for a post-SWIFT world was emerging. None of these developments, individually, posed an existential threat to dollar hegemony. CIPS handled perhaps 1% of the transactions that SWIFT did. The yuan represented only 3% of global reserves, compared to the dollar's 60%. Cryptocurrencies remained volatile and poorly understood. The petrodollar system, while aging, still functioned. Inertia is a powerful force in financial markets. The dollar remained dominant because it had always been dominant, because systems were built around it, because alternatives seemed risky and unnecessary. What the world lacked was not capability, but motivation, a compelling reason to abandon a system that, while flawed and increasingly weaponized, still worked. Then came Ukraine, and with it the decision that transformed abstract concerns into urgent imperatives, theoretical alternatives into practical necessities. The decision to cut Russia from SWIFT was not the cause of dollar decline, but it was the catalyst that accelerated every trend that had been building for 2 decades, the spark that ignited kindling that had been slowly accumulating. The question was no longer when the dollar's dominance would end, but how quickly, and what would replace it. The immediate aftermath of the SWIFT disconnection produced exactly the panic that Western policymakers had anticipated. Russian banks scrambled to find alternative payment channels. International businesses with operations in Russia faced paralyzing uncertainty about how to pay employees, settle invoices, or repatriate profits. The ruble's value plummeted, and images of Russians queuing at ATMs to withdraw cash before their savings evaporated dominated global news cycles.
For a brief moment, it appeared that the economic weapon had worked precisely as intended. Moscow would be brought to its knees, forced to withdraw from Ukraine, or face complete economic isolation. But this initial chaos masked a far more consequential reality. The world's major economies were watching, learning, and most importantly, preparing. The first cracks in Western unity appeared not in Moscow, but in Brussels and Berlin. Europe, far more dependent on Russian energy than the United States, quickly discovered that financial warfare has collateral damage. Natural gas prices exploded to 10 times their historical averages. German industrial giants like BASF and ThyssenKrupp, which required cheap energy to remain competitive, saw their cost structures devastated overnight. Italian and French households faced energy bills that consumed 20% or more of average incomes. The European Central Bank faced an impossible dilemma: raise interest rates to combat inflation caused by energy costs, thereby crushing economic growth, or keep rates low and watch the euro collapse against the dollar. Europe's pain revealed a fundamental asymmetry in the sanctions regime. The United States, a net energy exporter with an ocean separating it from the conflict, could afford to maintain a hardline position. European nations, geographically proximate to Russia and deeply integrated into its energy infrastructure, could not. By late 2022, a quiet rebellion was underway. Hungary openly defied sanctions. Germany authorized the continued operation of Russian banks needed to process energy payments. Italian companies maintained business relationships through increasingly creative corporate structures. The united Western Front was fracturing, and the fractures centered on one uncomfortable truth: cutting Russia from the dollar system hurt Europe nearly as much as it hurt Russia. But the real transformation was occurring far from European capitals, in nations that had watched the swift disconnection with alarm and immediately began drawing conclusions about their own vulnerability. India, the world's most populous nation and fifth largest economy, moved with striking speed. Within months of the sanctions, India had constructed an entire parallel payment system for Russian trade. Bilateral trade, previously conducted in dollars, shifted to rupees and rubles. Indian refiners became the largest buyers of Russian crude oil, purchasing at steep discounts and refining it for sale to the very Western nations that had imposed sanctions. This arrangement benefited both parties enormously, while excluding the dollar entirely from transactions worth tens of billions annually. The India-Russia arrangement established a template that spread rapidly. Turkey, a NATO member, emerged as a critical financial bridge, with Turkish banks processing transactions that Western banks refused to touch. The United Arab Emirates, particularly Dubai, became a hub for trade flows that circumvented sanctions through gold trading, cryptocurrency transfers, and traditional hawala networks. These weren't rogue states defying international law. These were significant economies making calculated decisions that their national interests diverged from American policy preferences, and that maintaining access to Russian commodities was more important than maintaining ideological alignment with Washington. China, however, represented the most significant threat to dollar hegemony, and Beijing's response to the swift disconnection was nothing short of a strategic masterclass. Rather than openly challenging Western sanctions, which would have invited retaliation, China simply deepened its economic integration with Russia while simultaneously accelerating de-dollarization initiatives with the rest of the world. Trade between China and Russia, already substantial, exploded. By 2023, bilateral trade exceeded $200 billion, though increasingly little of it was actually denominated in dollars. Chinese banks, particularly the Bank of China and Industrial and Commercial Bank of China, developed sophisticated channels for processing yuan-ruble transactions that operated entirely outside the SWIFT network. More significantly, China used the crisis to accelerate yuan internationalization with countries far beyond Russia. The argument Beijing made to trading partners was simple and compelling. Diversification isn't anti-American, it's prudent risk management. Today Russia, tomorrow perhaps someone else. Why concentrate all your reserves in a single currency controlled by a single government that has demonstrated willingness to weaponize access to the financial system? This message resonated particularly strongly in the Global South, nations in Africa, Latin America, and Southeast Asia that had experienced their own confrontations with American financial power and had long memories of IMF-imposed austerity and debt crises. The numbers tell a stark story. In 2022, before the Ukraine invasion, the yuan represented approximately 2.7% of global payments tracked by SWIFT. By late 2023, that figure had nearly doubled to 4.7%, making the yuan the fourth most used currency for international payments. More dramatically, in direct trade between China and emerging markets, the yuan share jumped to over 25%. Central banks worldwide increased their yuan reserves by record amounts. Even traditional American allies began diversifying. France completed its first yuan-denominated liquefied natural gas transaction. Brazil and China agreed to conduct trade in their own currencies, eliminating the dollar from the largest trade relationship in Latin America. The Saudi Arabia agreement to accept yuan for oil sales, once unthinkable, was now being negotiated in earnest. The technological infrastructure for this de-dollarization was maturing rapidly. China's CPIS system, initially crude and limited, was being upgraded with remarkable speed. By 2023, it connected over 1,300 financial institutions across 100 countries, processing transactions worth over 100 trillion yuan annually. The system was becoming genuinely viable as a SWIFT alternative, particularly for transactions involving Chinese counterparties or yuan-denominated trade. Russia's own system for transfer of financial messages, SPFS, connected with CPIS, creating an entirely separate financial communications network. India was developing its own unified payments interface for international use. These systems weren't just theoretical alternatives, they were processing real transactions, moving real money, settling real trade. Perhaps most threatening to long-term dollar dominance was the acceleration of central bank digital currency development. China's digital yuan, the ECNY, moved from pilot programs to widespread domestic adoption and began trials for cross-border transactions. The technology promised to make international transfers faster, cheaper, and more transparent than the correspondent banking system that underpins SWIFT. More importantly, CBDCs could be programmed to operate entirely outside Western financial infrastructure. A digital yuan could be transferred directly from a Chinese exporter to a Brazilian importer, settled instantly, with no American bank, no SWIFT message, and no dollar involved whatsoever. The cruel irony was that American policymakers understood these risks intellectually. Numerous reports from think tanks, testimony from Treasury officials, and warnings from financial institutions had outlined the dangers of overusing sanctions and financial pressure. But geopolitical imperatives in the moment overrode long-term strategic considerations. The desire to punish Russia, to demonstrate Western unity, to support Ukraine, to show that aggression carries consequences, all of these objectives were legitimate and understandable. But they came at a cost that was only beginning to materialize: the acceleration of a global financial reorganization that would ultimately diminish American power far more than any single foreign policy victory could enhance it. By late 2023, the global financial system existed in a state of uncomfortable dualism. The dollar remained dominant, but its dominance was no longer unchallengeable. Alternative systems existed, were functional, and were growing. The question was no longer if the dollar's hegemony would end, but whether its decline would be gradual and managed or sudden and catastrophic. And with every new sanction, every frozen asset, every nation cut from the financial system, that decline accelerated. The weapon that was supposed to destroy Russia was instead destroying the very foundation of American financial power. By late 2023, the global financial system existed in a state of uncomfortable dualism. The dollar remained dominant, but its dominance was no longer unchallengeable. Alternative systems existed, were functional, and were growing. The question was no longer if the dollar's hegemony would end, but whether its decline would be gradual and catastrophic or sudden and catastrophic. And with every new sanction, every frozen asset, every nation cut from the financial system, that decline accelerated. The weapon that was supposed to destroy Russia was instead destroying the very foundation of American financial power.
The final unraveling of dollar hegemony will not announce itself with a dramatic crash or a single catastrophic event. Instead, it manifests as a slow erosion, a gradual shift in the tectonic plates of global finance that becomes irreversible long before most observers recognize what has occurred. By 2024, the signs were unmistakable for those willing to see them. The world was not abandoning the dollar in a revolutionary upheaval, but rather quietly, methodically, building the infrastructure for a post-dollar era. And the swift disconnection of Russia had accelerated this process by years, perhaps decades. Consider the mathematics of reserve currency decline. When the dollar represented 85% of global reserves in the 1970s, losing 5 percentage points was relatively insignificant. But as that share declined to 60%, then 58%, then 55%, each additional percentage point lost represented an accelerating trend. Network effects that once reinforced dollar dominance, the fact that everyone used dollars because everyone else used dollars, began working in reverse. As alternatives became viable, the switching costs declined. Countries that had diversified 10% of their reserves into yuan or gold found the process less disruptive than feared, which encouraged further diversification. The dollar remained the largest single reserve currency, but its inevitability had vanished. And in financial markets, the loss of inevitability is often the prelude to the loss of dominance. The petrodollar system, that cornerstone of dollar hegemony established in the 1970s, began showing particularly acute stress fractures. Saudi Arabia's 50-year agreement with the United States, which had been renewed and extended repeatedly, expired in 2024 without renewal. The Saudis did not dramatically abandon the dollar, but they began accepting yuan for oil sales to China, their largest customer. The United Arab Emirates followed suit. Russia, Iran, and Venezuela, all major oil producers now operating outside the Western financial system, settled energy sales in alternative currencies. The result was not the immediate collapse of the petrodollar, but rather its transformation from a global standard into merely one option among many. Oil could now be purchased in dollars, yuan, rupees, or even through barter arrangements. The monopoly had been broken. The consequences for American borrowing costs were profound and inexorable. For decades, the United States had enjoyed what French Finance Minister Valéry Giscard d'Estaing called an exorbitant privilege, the ability to borrow in its own currency at artificially low interest rates because foreign central banks needed to hold dollar reserves. As global dollar reserves declined, foreign demand for U.S. Treasury bonds softened. The Federal Reserve found itself increasingly the buyer of last resort for American government debt, effectively monetizing fiscal deficits. This worked in the short term, but stored up inflationary pressures that would eventually manifest. The American government's ability to run trillion-dollar deficits without immediate economic consequences, a superpower taken for granted for generations, was quietly disappearing. Meanwhile, the BRICS nations, Brazil, Russia, India, China, and South Africa, were evolving from a loose diplomatic grouping into a genuine economic bloc with monetary ambitions. At their 2023 summit, they announced plans for a common currency for international trade settlement backed by a basket of commodities, including gold, oil, and rare earth minerals. The project was ambitious, technically complex, and faced enormous coordination challenges. But its mere existence represented a psychological breakthrough. For the first time since Bretton Woods, a credible alternative to the dollar-based system was being designed by countries representing 40% of the global population and 25% of global GDP. Even if the BRICS currency failed or underperformed, it demonstrated that the dollar system was no longer accepted as natural and permanent, but rather as one arrangement among possible alternatives. The fragmentation of the global financial system carried dangers that extended far beyond American interests. The post-war economic order, for all its inequalities and hypocrisies, had facilitated unprecedented global prosperity. International trade had exploded, lifting billions from poverty, because a common currency and shared financial infrastructure made cross-border transactions relatively simple and predictable.
A world of competing currency blocks, parallel payment systems, and incompatible financial regulations would be a world of higher transaction costs, greater uncertainty, and slower economic growth. The inefficiencies of converting between multiple reserve currencies, navigating different payment systems, and managing currency risk across fragmented markets would act as sand in the gears of global commerce. There were also profound implications for global security. American military hegemony had always rested partly on economic foundations. The ability to sanction adversaries, freeze assets, and deny access to the financial system had been a tool of statecraft more flexible and less destructive than military force. As that tool lost effectiveness, American foreign policy would necessarily become more reliant on traditional military power, or more willing to accept outcomes it could not shape. Neither option was appealing. Meanwhile, China's economic leverage would grow proportionally as yuan usage expanded, giving Beijing tools of economic coercion that it previously lacked. The competition between American and Chinese spheres of influence would take on an explicitly monetary dimension. The cryptocurrency and blockchain revolution, initially dismissed by central bankers as a fringe phenomenon, now represented an additional threat to all traditional monetary systems, including the dollar. By 2024, stablecoins pegged to various currencies were settling over $3 trillion in annual transactions, with growth rates exceeding 50% annually. El Salvador's Bitcoin experiment, initially mocked, had been followed by several other nations exploring cryptocurrency adoption. Most significantly, the technology demonstrated that value could move across borders instantly, cheaply, and without government intermediation. For remittance corridors, international business transactions, and capital flight, blockchain-based systems offered compelling advantages over traditional banking. The dollar might lose dominance not to the yuan or a BRICS currency, but to decentralized protocols that recognize no national sovereignty at all. Looking forward, several scenarios present themselves. In the optimistic case, the dollar undergoes a managed decline, gradually losing market share over decades, while remaining a significant reserve currency among several. American policymakers accept this new reality and adjust fiscal policies accordingly, reducing deficits and managing the transition without crisis. International cooperation produces new institutions that facilitate trade in a multipolar currency environment. This outcome is possible, but requires wisdom and restraint that has been notably absent from recent policy debates. The pessimistic scenario involves a crisis of confidence. Perhaps a debt ceiling standoff in Washington, perhaps another round of aggressive sanctions against a major economy, perhaps simply the crossing of some psychological threshold in reserve currency diversification. Confidence in dollar assets evaporates rapidly. Foreign central banks and sovereign wealth funds simultaneously attempt dollar exposure. Treasury bond yields spike. The dollar collapses in value. The Federal Reserve faces an impossible choice between defending the currency through catastrophic interest rate increases or accepting hyperinflation. The American standard of living, propped up for decades by cheap imported goods made possible by dollar dominance, adjusts violently downward. This scenario remains unlikely in the immediate term, but its probability increases with each year that structural imbalances remain unaddressed. The most likely scenario lies between these extremes, a gradual, grinding erosion of dollar dominance that happens slowly enough to avoid panic, but quickly enough to significantly reduce American economic and geopolitical power within a generation. By 2040 or 2050, the dollar might represent 30 to 40% of global reserves, rather than 60. China's economy might be 50% larger than America's, and the yuan might be the preferred currency for trade throughout Asia, Africa, and parts of Latin America. This would not be the end of American power, but it would be the end of American primacy, the closing of a unipolar moment that lasted barely 3 decades. The great historical irony is that the swift disconnection of Russia, intended as a demonstration of American financial might, may be remembered as the moment that illusion shattered. The weapon worked exactly once, against a target that could not effectively retaliate, and in circumstances where Western unity could be temporarily maintained. But in using it, the United States revealed both the extent and the limits of its financial power. It showed the world what was possible, and thereby motivated the world to ensure it would never be possible again. Every nation, every central bank, every finance ministry drew the same conclusion. Dependence on the dollar system was an unacceptable strategic vulnerability. And once that conclusion was reached, the end of dollar hegemony became not a question of if, but merely of when. The dollar will not collapse tomorrow.